Well, good afternoon, everyone, and welcome to our November Market Insights. Before we launch today's session, we need to hear from our legal group. Perfect. Well, we're about just over a week out of the election. It's been a real quiet November, huh? Just as we expected. Before we get into today's topics, Gavin, could you give us a recap of what's occurred since our mid-October session?
Sure. Really what we called out last month was a shift from kind of a Goldilocks quad one to reflation theme, which really was the important part is that inflation we thought was going to start to accelerate again. In fact, we just got today's inflation data, which does show that inflation did accelerate a bit. I'm sure Rich will touch on that a bit more. But really more of the same in terms of what we thought towards the end of the summer is that maybe too many rate cuts were priced in and that the market started to reprice accordingly to the idea that there won't be as many cuts. And when we spoke last time, that's what had started to happen. And then since that meeting, even more so to the point where we are now. So that's basically to catch us up from last time, and then of course the election, which I'm sure we'll touch on a little bit further.
Yeah, I would just add, right now it's pretty clear that the market regime is quad two. That's growth and inflation both accelerating. The inflection that we called out last time, that inflation is going to start kind of meandering higher, looks like it's underway. Today's report, the 3-month annualized number for inflation is above the year-over-year number. And 4 out of the 5 different inflation measures that we track, 3-month annualized higher than the year-over-year number, which itself is a sign of reacceleration. If that holds, then we're talking about inflation resuming higher. I mean, we're not talking about drastic, but we are way above consensus on inflation. And the Fed is pre-committed to getting the Fed funds rate down to their target, what they deem neutral. So the setup is we probably are going to see consecutive months where inflation is moving up in the wrong direction away from the Fed's target. Meanwhile, the Fed is going to cut anyway. And that, is consistent with quad two. And I would just say if that's until the Fed backs away from that, that might just give further room, for quad two, to run. It could be something that extends out, 4, 5, 6 months instead of 2 to 3 months.
Well, that's an interesting take on things. I know inflation has been really the dominant theme here for the better part of 2 or 3 years. And as we move on to our next question, we can't escape it because it's been the talk of the town for the better part of 6 months. But as we sit here today, it looks like Republicans will take the House and hold all 3 sides of government, clean sweep, red wave, however you want to call it. What are your thoughts on that? And how do you think that plays out for the economy, for the markets?
But just, kind of a joke, this ties it to the Fed. I've seen people comment that, the Fed excludes food, energy, and housing from their inflation calculations, but voters don't.
Right. That's a very good point.
Well, I mean, a couple of things. I'll start with the quarterly refunding announcement. This is something that we've addressed, periodically over the last year plus. This is where the Treasury Department comes out and announces their issuance for the coming quarter, both the size And then the auction schedule details whether they're issuing long-term bonds, short-term T-bills, et cetera. The implication for investors is depending on how they issue bonds, they either take liquidity out of the system, take bank reserves out of the system, or they don't. If they issue anything with a coupon 1 year or longer, it drains bank reserves. That's a headwind for liquidity, and investors, need to be mindful of that. If they issue T-bills, it is going to, instead of taking bank reserves out of the system, it's just going to drain one of the facilities at the Federal Reserve. Now, from October of last year, this time last year, is when they made the major pivot and said, we're going to pull way back on coupons and issue bills. That was a big positive for liquidity, and markets rallied that quarter. And in January, April, July, and just now, the last one in end of October, they've kicked the can down the road. The size of the deficit says that they should be issuing coupons, long-term bonds, terming this out, locking in today's rates before they lose the bond market. Every quarter it comes up, they kick the can down the road, meaning they continue to rely heavily on bills. Well, the facility at the Fed is almost drained or will soon be drained. So no matter what the Treasury does, they're going to be draining bank reserves. And how nice of them to kick the can down the road and just say, it's not our problem, it'll be the next administration's problem. So I would put that out front and center to maybe, dampen some of the enthusiasm. Where you had a positive market response, right after. There are things though that, could derail things. And if the Treasury gets back to issuing coupons, that's just going to mean that the bear market in bonds is going to continue that much longer. And if rates back up, if term premiums expand, there will come a limit where higher rates start to pinch, equity valuations. So to me, that's like the number one negative, that's out there. That now I had a client I talked to 2 days before the election. I won't say what side they were on, but they basically said, if the outcome is this way, I want to go all cash. If the outcome is that way, I want to be fully invested. Obviously, that's an extreme, and we don't want, anybody, to operate that way. Gavin and I feel pretty confident that our process is designed to pick up inflections in growth, inflation, liquidity. So there's nothing political, about the process. It is, somebody's going to be in power. They're going to try to enact things, regardless of what those things are. It boils down to, from a market perspective, it boils down to, is growth going to accelerate or decelerate? Is inflation going to accelerate or decelerate? Is liquidity going to accelerate or decelerate? And we'll operate and adjust, accordingly.
Well, that's a lot to digest, and it really kind of dovetails into the final question. And I know we all hate to make predictions, but people clamor for them. And I think you touched a bit on this, Rich, in the last question. But what would the outlook be, or if you were to put your futuristic cap on, what is the outlook for the economy, inflation, and markets for 25 as we kind of head into the sunset of 24?
I mean, we would look at it as a range of probable outcomes, right? So any forward-looking, any forecast that basically says this is what's going to happen, I don't know any of those that really materialize. But what we try to do is to say the base case, which for us is inflation is going to reaccelerate from here. That's probably going to have legs well into next year. That's out of consensus. Consensus has inflation continuing to land gently right on top of the Fed's target, and the numbers just don't, add up for us that way. growth is accelerating, but mildly. We're not getting a huge, boost yet, but, it's not decelerating. So it's accelerating growth, accelerating inflation is quad two. We do see that transitioning into quad three when you start to look out, into second quarter, third quarter. But the magnitude of deceleration is small. Second quarter is like 7 basis points of deceleration. That's not enough to cause, reallocations and flows that are disruptive. So if all we get is 7 basis points of deceleration, that's probably still going to look like quad two. So that's kind of our base case. Now, on top of that, you can say, well, what are the extremes on either side? The extreme bull case, the extreme bear case, which we try to do regularly just to say we want to be able to track this. And to the extent we see things materialize that are a component of the bullish case, we want to respond to that. And if we see other things that are part of the bearish case, we want to respond to that. So the bear case, in terms of a more extreme, would be that, we have huge budget deficits as a share of GDP, all-time record, except for momentarily after World War II and the brief period around COVID. Somebody's got to buy those bonds. The Fed's not buying, they're selling. Central banks all over the world are not buying. Commercial banks are up to their eyeballs still in bonds they bought prior to, the crash in bonds in 2022. That leaves folks like us and our clients, other private sector buyers, to take up the slack. We buy because we want to, not because we have to, which means we're price sensitive. And if they have trouble selling these bonds, there could be another leg down in the bond market where risk premiums expand. And if they expand enough, then equity valuations are going to contract. And that would be the bear case. That would be, something that, would test, people's resolve. It would certainly, in the political environment, contradict what the administration is trying to do, give ammunition to the other side, saying, hey, the market is selling off because of you guys, when in reality it's selling off for things that, we've been tracking, all along. So that would be, the bear case for me. The bull case, it really depends what they do. So I look at it and say, the only real driver of the economy is business investment. Every dollar of business investment generates 45 cents of GDP every year. There is no better game in town. So I'm going to be watching, all the things that they say they're going to do, how much of it translates into business investment. If it translates into business investment, it means the capacity for the economy to grow is expanding. And that would mean that, growth would be more durable. Larry Summers, well-known economist, has been in and out of numerous, administrations, Treasury Department, et cetera, is out saying that this is going to cause inflation to explode. What I think he's missing, first of all, inflation is already going to move up. Unlikely that it explodes. He was in the Treasury Department and basically said the same thing in 1980 or 81. And what they miss is that you have one portfolio, the global portfolio, that today's probably $300 trillion. If the US does something that is incrementally positive for business investment, and that global portfolio shifts by 1%, that's a $3 trillion flow into the economy, which is about 11% of GDP. Those kind of effects would be more than enough to provide financing for treasuries that the Treasury Department has to sell. So there are plenty of offsetting things. That I think is off the base. I also see comparisons that if you line up this market relative to Reagan's victory, there was a sharp bear market and recession that followed in the first year. And so far, the graphs do track each other, but the thing that caused recession then is that they phased in the tax cuts. You know, if you announce a tax cut today, say it's going to kick in next year, everybody that can defers as much economic activity as they possibly can into the next year, and that creates an air pocket. You know, if taxes are on the table and they announce they're going to be phased in, you know, that could be enough to create an air pocket and send us into, you know, a deeper, you know, quad three. And you know what they're doing on this government efficiency, you know, panel or whatever you call it. And in full disclosure, I did work as an economic advisor for Vivek. I think he's one of the sharpest guys I've ever encountered, and I would never bet against him in anything. So he's already outlined 1,200 government programs that have outlived their expiration. They are not authorized by Congress, yet they still get appropriations, and it adds up to about $500 billion. So that thing alone to say, are we going to end all those and save $500 billion? And if Congress really wants those programs, they'll just have to pass another bill, you know, to get there. And you know, there are things like that that could lead to some meaningful. They're not going to cut. They're not going to close the deficit just by those kind of cuts. Most of the spending is mandatory, where you know all hell breaks loose if you try to cut Social Security, Medicare. I don't think they're going to do that. But any reduction in spending is going to take pressure off the Treasury when it comes to these quarterly refunding announcements. And to the extent that it can shrink what we think is a risk factor, you know, there are, you know, certainly positive scenarios out there where this could be quite good. And it's just a matter of saying, we don't want to get distracted with that one way or the other, because so much has to happen to get anything through the sausage factory. The deadline on this government efficiency isn't until 2026. You know, it's going to take a lot of work. There's going to be a lot of noise. There's going to be a lot of political bickering and all that. And for us, it just goes right back to what's the impact on growth? What's the impact on inflation? What's the impact on liquidity? And we'll make adjustments as, you know, things evolve.
Well, that's a lot. We'll see what occurs here as the new regime takes over. The Republicans have have a full deck here, so they should be able to get done whatever they want to get done, and we'll certainly see how that plays out. So until next time, thanks guys, and look forward to seeing you post Thanksgiving in mid-December.
All right, sounds good. Take care, guys.
See you later.